On the day Kevin Warsh was sworn in as Federal Reserve Chair, the S&P 500 touched 7,500 for the first time in history. The Dow crossed 50,000. Nasdaq 100 pushed to 29,602. By every surface reading, Thursday was a day the market voted confidence in the new central bank leadership. But the bond market filed a different ballot. The U.S. dollar index climbed to a two-week high as Fed funds futures shifted further away from rate cuts and toward the possibility of hikes. Treasury yields rose. Inflation expectations, embedded in the bond market since the Iran war drove energy prices higher, remained elevated. TD Securities extended its forecast for a Fed pause into 2027. UOB described the path as extended pause before cautious easing. Neither framing matches a stock market printing all-time records. Cerebras Systems debuted on Nasdaq Thursday with a 90% first-day surge, priced at $185 and opening near $350, minting the largest IPO of 2026. Applied Materials reported fiscal Q2 revenue of $7.91 billion, beating estimates by 2.7%, and guided the next quarter to $8.95 billion, 9.2% above what analysts expected. Cisco had already lit the fuse earlier in the week, posting results that sent Goldman Sachs raising its price target to $116. Every earnings data point was confirming the AI infrastructure thesis. Retail investors, Goldman noted separately, had led the entire market recovery off February lows. The mood on the equity floor was unambiguous. AI demand justifies the price. That is the read equity investors are going with. It is not the read the bond market is offering.
The divergence between stock and bond markets is not new. What is new is who now has to navigate it. Warsh was confirmed 54-45, the most partisan confirmation vote in Fed history, and he takes over a central bank where the sitting governor, Stephen Moran, resigned the same day. Jerome Powell's term ended Friday. The institution Warsh inherits has a 2% inflation target it has not met, an inflation rate running above that target, and a bond market that, as CNBC phrased it directly, believes the Fed is behind the curve. Here is the mechanism the bond market is pricing. The Iran war has sustained an energy price floor. That energy floor feeds into production costs, which feed into producer price index readings. PPI for the period rose 6%. Tariff pass-through from the U.S.-China trade structure has not fully cleared. Treasury Secretary Scott Bessent said Thursday that he sees substantial disinflation ahead after one or two more hot prints. But the qualifier is the weight-bearing word. One or two more hot prints means the data the bond market is pricing is still in front of us, not behind us. Equity investors are discounting AI earnings power over a 3 to 5 year horizon and treating near-term inflation as a cost input that technology productivity will eventually outgrow. Bond investors are pricing the next 12 months of Fed decisions, where Warsh's stated preference for price stability over accommodation maps directly onto rate hike probability. Ford surging 22% in 2 sessions on a Morgan Stanley note about a battery energy storage business worth potentially $10 billion by 2028 illustrates the time horizon equity investors are operating in. They are pricing futures the Fed cannot yet validate. The bond market's problem is not that it disbelieves the AI thesis. The problem is that Warsh cannot cut rates into an inflationary environment without destroying the credibility he arrives with, and the equity market's current pricing assumes that rates either stay flat or fall. If Warsh moves towards tightening to close the credibility gap, the valuation math that justified S&P 7,500 becomes load-bearing in a way it has not been tested yet.
The last time a new Fed chair inherited a similar split between equity exuberance and bond market alarm was early 1999, when the Nasdaq was pricing the internet at multiples the underlying earnings could not support, and the bond market was already pricing a tightening cycle that would arrive 12 months later. The equity market was right about the technology. It was wrong about the time horizon and the rate path. Stocks peaked in March 2000, 13 months after the split became visible in the yield curve. That parallel does not predict an identical outcome. AI earnings, unlike late 1990s internet earnings, are real and accelerating. Applied Materials' $8.9 billion guidance is not a projection built on clicks. But the parallel does clarify the variable that resolves the tension. In 1999, it was whether the Fed would tighten faster than equity multiples could absorb. In 2026, the question is whether Warsh will signal a rate path that the equity market has not priced. Two conditions determine which direction the divergence resolves. If the next CPI print comes in below 3% and energy prices soften as the Iran situation stabilizes, the bond market's hike pricing deflates, equities stay supported, and the split closes in the stock market's favor. The Sense substantial disinflation call gets vindicated. The S&P 7500 level becomes a defended base rather than an exposed frontier. In that scenario, watch whether the 10-year Treasury yield falls back toward 4.5% within the next 2 weeks. That would be the bond market's concession. The other condition runs harder. If the June CPI print, the first major data point Warsh will own, comes in hot, the bond market's current pricing of tighter policy firms up. Warsh faces a public test: signal accommodation and sacrifice credibility, or signal tightening and hand the equity market its first genuine re-rating since February's correction. The S&P's defense of 7,500 then depends entirely on whether AI earnings growth is fast enough to offset a multiple compression driven by a rising real rate. That calculation has never been run at these valuations. Klarna posted its first ever quarterly profit Thursday, $1 million net on revenue that crossed $1 billion for the first time, a 44% year-over-year gain. It is a minor figure, but it represents exactly the kind of real earnings inflection the equity bull case requires to hold under pressure. If the AI infrastructure cycle keeps converting into actual income statements at this rate, the equity market's discounting may prove out. If it does not, if the next round of earnings shows the spend without the return, the bond market skepticism has a harder case to make. Warsh's first press conference after a Fed decision will be the moment both markets are forced to reconcile. What question does he refuse to answer directly? Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.